40.38. This single number just triggered the most urgent risk assessment I've conducted in my 15-year career tracking market valuations. I'm Marcus Caldwell, and what I'm about to show you isn't opinion or speculation. This is 155 years of historical data pointing to the same mathematical conclusion. The question isn't whether a correction is coming. The question is whether you're positioned for what the valuation metrics are screaming. Here's what institutional analysts are quietly discussing behind closed doors. The Shiller Price-to-Earnings ratio, also called CAPE for cyclically adjusted price-to-earnings, now sits at 40.38. To put that in perspective, in 155 years of recorded market history, this metric has only exceeded this level once: December 1999. Exactly 100 days before the dot-com crash erased $6 trillion in market capitalization. The Nasdaq fell 78%. It took 7 years just to break even. The Shiller P ratio was created by Robert Shiller, Nobel Prize-winning economist at Yale. Here's how it works. You take the current price of the S&P 500, divide it by the average inflation-adjusted earnings over the past 10 years. This methodology smooths out short-term earnings volatility in economic cycles. It reveals what the market is actually worth relative to fundamental earnings power. The historical average dating back to January 1871 is 17.33. Right now, February 2026, we're at 40.38. That's 135% above the long-term average. Think about what that premium means. You're paying $2.35 for every dollar of earnings that historically cost $1. If this were real estate, you'd be paying $2.35 million for a house that consistently sold for $1 million over the past century and a half. Now here's where the historical data becomes critical. In 155 years, there have been exactly 6 periods when the Shiller PE stayed above 30 for at least 2 months during a bull market. 6 times. Let me walk you through what happened after each instance. 1929, Shiller PE hit 32.5. The market crashed 89%. The Great Depression followed. Recovery took 25 years. 1965 to 1968, Shiller PE ranged between 24 and 30. The market entered a lost decade. Stagflation destroyed real returns. 1999 to 2000, Shiller PE reached an all-time peak of 44.19. The dot-com bubble exploded. S&P 500 fell 49%. Nasdaq down 78%. $6 trillion in wealth evaporated. 2007, Shiller PE hit 27. The financial crisis followed. S&P 500 fell 57%. 8.8 million Americans lost jobs. 22 trillion in household wealth destroyed. 2021, Shiller PE reached 38.5. 2022 correction followed. Market fell 25%. And now, 2025 to 2026, we're at 40.38. Second highest reading in 155 years. The track record is perfect. 6 out of 6, 100% historical accuracy. Every time the Shiller PE exceeded 30 and sustained that level, a major correction followed. The magnitude ranged from 20% to 89%, but the pattern never failed, not once in over a century of data. Before I show you the mathematical projection for what comes next, if this kind of institutional-level market intelligence is valuable to you, hit that subscribe button and turn on notifications. This channel exists to provide the quantitative analysis and historical context that helps you understand structural market risk before it materializes. Your subscription directly supports independent financial research that isn't constrained by Wall Street's optimistic bias. Now let's examine the mathematical implications. When the Shiller PE ratio has exceeded 30 during bull markets, it has never found a bottom during the subsequent correction at a level higher than 27. Never. Not in 155 years of data. We're currently at 40.38. If history holds and the ratio reverts to 27, that's a simple calculation. 40.38 divided by 27 equals 1.496. That represents a 49.6% premium that needs to be eliminated. Now, I'm using a more conservative projection of 33 to 39% for the base case scenario. Why the difference? Because the Shiller PE doesn't always fall all the way to 27. Sometimes it stabilizes at 30, sometimes 32. So the minimum drop scenario, if the ratio only falls to 30, requires a 33% market decline. That's the best case reversion. If it falls further to 20 or 15 like it did during the 2008 financial crisis, you're looking at 40 to 50% drawdowns or more. Let me translate that into S&P 500 price levels. The index currently trades around 6,900. A 33% decline takes you to 4,600. A 40% drop brings you to 4,100. A full mean reversion to a Shiller PE of 15, similar to 2008, puts the index at 3,500. That's a 50% wealth destruction event. Your $500,000 retirement account becomes $250,000. Your $1 million portfolio becomes $500,000, half your net worth erased. Before you dismiss this as impossible, remember it's already happened multiple times. 2008, 57% drop. 2000 to 2002, 49% drop. 1929 to 1932, 89% drop. The historical precedent is clear. Now here's what makes the current setup particularly concerning. Market concentration. Right now, 7 companies control over 1/3 of the entire S&P 500. Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta, and Tesla, the Magnificent Seven. Together, they comprise between 31 and 37% of the index total market capitalization. 37%. The last time the market exhibited this level of concentration was 2000, the dot-com peak. The top 7 stocks then represented approximately 35% of market weight. We all know what happened next. They crashed and dragged the entire index down with them. But here's what makes today's concentration more systemically dangerous. In 2000, if you owned an S&P 500 index fund, you had genuine diversification across 500 companies, multiple sectors, varied business models. If one stock declined, the others provided portfolio cushion. Today, 37% of your index fund is concentrated in just 7 names. If those 7 experience significant drawdowns, your entire portfolio follows. You're not diversified, you only believe you are. Vanguard and Fidelity have actually updated their fund prospectuses to warn investors that their S&P 500 funds may become technically non-diversified under regulatory definitions. Think about what that means. The most widely held index fund in America, marketed as the safest, most diversified core holding, is now a concentrated bet on 7 technology stocks. And if those 7 decline 40 to 50%, passive index holders experience similar losses. Now let's add another risk layer. 2026 is a midterm election year. Since 1957, there have been 17 midterm elections. 12 of them resulted in stock market corrections of 10% or more. That's a 70.6% historical probability. The average intra-year drawdown, meaning the maximum peak-to-trough decline at any point during the year, is 18%. Even in years that finished flat or positive, the market typically dropped 18% at some point during the election cycle. Why does this pattern persist? Midterm elections create policy uncertainty. Which party controls Congress? Will the administration's agenda advance or stall? Will there be legislative gridlock, potential government shutdowns? Institutional investors reduce exposure during periods of elevated political uncertainty. They sell first, wait for clarity, then redeploy capital. But 2026 presents additional complications beyond normal midterm dynamics. Current tariff policy has pushed import taxes to levels not seen since the 1930s, the Great Depression era. These tariffs are creating margin pressure across multiple industries. Some companies are absorbing the costs, compressing profits. Others are passing them through to consumers, creating inflationary pressure. This puts the Federal Reserve in a difficult position. They want to support economic growth through rate cuts, but sticky inflation above their 2% target constrains their flexibility. If they cut rates too aggressively while inflation remains elevated, they risk reigniting price pressures and losing credibility. But if they maintain restrictive policy while the economy slows, unemployment rises and recession risk increases. There's no easy path forward. Speaking of the Federal Reserve, let me show you two critical signals from recent meetings. September 2025, Fed Chair Jerome Powell made a highly unusual statement. Quote, "By many measures, equity prices are fairly highly valued." End quote. That might sound like typical central bank language, but it's extraordinary. The Federal Reserve almost never comments directly on stock market valuations. They maintain strict neutrality on asset prices. They discuss employment, inflation, interest rates, but not whether stocks are overvalued. Powell's statement was a 5-alarm warning for anyone who understands central bank communication. Then December 19th, 2025, the Federal Reserve cut rates by 25 basis points. Standard policy adjustment, nothing unusual. Except 3 members of the Federal Open Market Committee voted against the decision. 3 dissenters. The last time 3 FOMC members dissented was 1988, 37 years ago. And here's what makes it more significant. The 3 dissenters didn't even agree with each other. Some wanted to hold rates higher to combat inflation. Some wanted more aggressive cuts to support growth. They were arguing in opposite directions. What does that tell you? The people with access to every economic data point in the country cannot reach consensus on the policy path. If they can't determine the appropriate response, what does that say about the clarity of the economic outlook? Now let me address what many investors are thinking. We survived 2008, we'll survive this too. The government will intervene, the Fed will cut rates, they'll print money, they'll bail everyone out. Here's why 2026 is structurally different from 2008. In 2008, the Federal Reserve had 525 basis points of room to cut interest rates. They started at 5.25%, cut all the way to zero, massive monetary stimulus. They also deployed quantitative easing, buying bonds, injecting liquidity, expanding the balance sheet from $1 trillion to $4.5 trillion. $3.5 trillion created to stabilize the financial system. And it worked. The crisis ended, the economy recovered, the stock market came back. In 2026, the Fed has significantly less ammunition. Interest rates are currently at 3.75%. If they cut all the way to zero, that's only 375 basis points of stimulus, 70% less firepower than 2008. But they can't even go to zero. Why? Because inflation is still running at 2.7% CPI, core PCE at 2.8%. The Fed's target is 2%. If they cut rates too aggressively while inflation remains above target, they risk losing credibility and reigniting price pressures after spending 3 years fighting inflation. They're trapped between supporting growth and maintaining price stability. And quantitative easing? The Fed's balance sheet is still over $7 trillion. They've already done multiple rounds of QE. The effectiveness is diminishing with each iteration. Like building drug tolerance, the first dose works great. The 10th dose barely registers. Plus, the government is $38.3 trillion in debt. They're paying over $1 trillion per year just in interest payments. More than defense spending, more than Medicare. Just interest on existing debt. If they try to pass another $700 billion bailout package like TARP in 2008, the bond market will revolt. The political will doesn't exist. Americans remember 2008, they remember bankers getting bailed out while homeowners lost their houses. There will be no bailout this time. You're managing your own portfolio risk. Let me give you the 3 most likely scenarios and their probability distributions. Scenario 1, soft landing, probability 30%. The Fed cuts rates 2 to 3 times, 50 to 75 basis points total. AE spending from the Magnificent Seven starts producing measurable returns. The midterm elections cause a normal 10 to 15% pullback. Nothing catastrophic. No major geopolitical shocks. The market corrects to 5,900 or 6,200. Recovery takes 3 to 6 months. This is the optimistic scenario, and it's possible. But given the valuation extreme, concentration risk, and policy constraints, it's not probable. 30% chance. Scenario 2, hard landing, probability 50%. This is my base case. The market drops 25 to 35%. S&P 500 from 6,900 to 4,500 or 5,200. Here's the timeline. Q2 2026. Earnings disappoint. Market drops 10%. Q3. Midterm uncertainty peaks. Recession fears spread. Another 15% decline. Q4. Recession confirmed. Unemployment spikes. Final 5 to 10% drop. Total drawdown 30 to 35% from peak. The VIX hits 60. Unemployment reaches 6 to 7%. The Magnificent Seven lose 40% on average. The Fed cuts rates aggressively, but inflation constraints prevent them from going to zero. The recession lasts 12 to 18 months. Market recovery takes 2 to 3 years. If you have a $500,000 portfolio, you lose $150,000. 50% probability, most likely outcome. Scenario 3, market crash, probability 20%. This is the tail risk scenario. Everything breaks simultaneously. A major AI company admits their capital expenditure isn't producing adequate returns. Simultaneously, a geopolitical crisis erupts. A significant regional bank fails due to commercial real estate exposure. Credit markets freeze. The Fed cuts to zero, does unlimited QE, but it doesn't stop the panic. The market crashes 40 to 50%. S&P 500 from 6,900 to 3,500 or 4,000. Your $500,000 retirement account becomes $250,000 or less. Unemployment hits 10%. Recovery takes 5 to 7 years. 20% probability, lower than scenario 2, but not impossible. So what do? Let me give you 5 warning indicators to monitor. If 3 flash red, reduce equity exposure. If all 5 flash red simultaneously, go maximum defensive. Warning 1, the VIX Fear Index, currently at 18.64. If it hits 25, caution. If it hits 50, crisis. Monitor daily. Warning 2, the Magnificent Seven individual performance. If 3 fall 20%, correction initiating. If all 7 fall 20%, crash imminent. Monitor daily. Warning 3, credit spreads on high-yield bonds, currently at 2.86% above treasuries. If spreads hit 8% or higher, credit crisis. Monitor weekly. Warning 4, unemployment rate, currently 4.4%. If it hits 6%, recession confirmed. Monitor monthly. Warning 5, Federal Reserve emergency actions. If the Fed calls an unscheduled emergency meeting, red alert. History shows emergency Fed meetings happen before crashes, not after. Monitor Fed communications constantly. Here's what this means for your specific situation. If you're 65 planning to retire next year and scenario 2 happens, you lose $150,000 on a $500,000 portfolio. You can't retire. You keep working 5 to 10 more years. If you're 55, 10 years from retirement, you can recover. But it takes 2 to 3 years just to get back to break even. If you're 40, you will recover. The market always comes back over sufficient time horizons. But watching your savings drop 30% is psychologically difficult. Let me synthesize the critical intelligence. The Shiller P/E ratio at 40.38 is the second highest reading in 155 years. The historical track record is perfect, 6 times above 30, 6 crashes followed, 100% accuracy rate. The math says minimum 33% correction. Base case 30 to 35%. Worst case 40 to 50%. 7 companies control 37% of the S&P 500. They're spending $500 billion on AI with unproven returns. 2026 is a midterm election year. 70% historical probability of correction. Add tariff policy uncertainty, Fed policy constraints, sticky inflation. This isn't one risk, it's multiple risks converging. The Federal Reserve warned us. Powell's September statement, December's three-way FOMC dissent. They can't agree on policy because the data is impossible to interpret. When the Fed is uncertain, markets become extremely volatile. Most likely timeline, Q2 2026, first cracks appear. Q3, midterm uncertainty peaks. Q4, recession confirmed. Bottom in late 2026 or early 2027. Recovery takes 2 to 3 years. This isn't prediction. This is mathematical probability based on 155 years of data that has never been wrong. The question isn't if the market will correct. The question is, are you positioned for what the valuation data is screaming? If this analysis helped you understand the structural risk, hit that like button. Subscribe and turn on notifications for the next video, where I break down specific defensive positioning strategies. Drop a comment. Tell me which scenario you think is most likely. This is the Equity Edge, where we decode market risk with data, not emotion. The Shiller P/E ratio has never been wrong in 155 years. Don't be the investor who ignores the mathematics.